We're looking at the mini version of a development financial model in which number 1, rentals activate upon development completion. Number 2, the land value is calculated through the residual methodology using the development profit margin as the function with which we find the land residual value. And number 3, the land can be contributed or purchased. Our model runs statistically based on the unit of measure that we choose, square feet or square meters. It is therefore suitable to a wide array of property types such as multifamily, mobile home parks, self-storage, single-family, warehousing, industrial, or office properties. Let's go through an investment case and see this model in action. This investment opportunity involves the development of a multifamily building in the US. We're setting our currency to US dollars, our measurement units to square feet as opposed to square meters, and our rental rates frequency from a yearly to a monthly basis. Upon development completion, we'll assume that we would take no time absorbing the newly developed rentable space, although we do have the option to input 1 year, 2 years, or more if we needed to, in which case absorption would happen on a linear basis. Let's assume that upon development completion, the rent we could achieve equals $5.5 per square foot per month, with an NOI margin of 68%. Let's populate now our development units. We'll assume it would take us 3 years to develop this property from land acquisition or contribution all the way to development completion. Let's estimate we would sell the property at the end of year 7, which would imply a 4-year rental period. By the way, in this model, the exit year must be greater than the development duration. We offer another development model with off-plan sales, not rentals, in which the disposition event or events is not correlated with the development completion mark. Let's imagine we would build 117,647 square feet of gross buildable area with an 85% efficiency. Regarding the land, we can choose whether we would like the land to be contributed or purchased. In this case, we'll opt for the contribution option. We're going to target a 35% development profit margin. Let's assume that hard costs before inflation, value-add tax, or goods and services tax amount to $170 per square feet of gross buildable area. Regarding the debt financing assumptions, we'll activate the development loan and the refinancing loan. Refinancing would occur the next day after development completion, which in this case means on the first day of year 4. We'll remain conservative and assume a 60% loan to cost or loan to value for both facilities. Let's suppose the interest rate of the development loan equals 8% and that of the refinancing loan 6%. We'll use a 1% refinancing amortization. In order to calculate our gross disposal proceeds, let's use a 5.5% exit NOI cap rate as well as 5% of the gross disposal proceeds as exit costs. We'll go for a 1% GP equity requirement participation. Talking about the GP, the fees he would be likely to charge for this project are a 1% land acquisition or contribution fee, a 3% asset management fee, a 1% disposition fee, no loan agent fee, and a 1% project management fee. Regarding the distribution waterfall, let's consider an 8% preferred return and a 20% promoted interest. Now that we have populated all our inputs, let's calculate our land residual value by pressing this button and making sure that our error-free calculation check returns a true result. We see that with a 33% development profit margin target, the land would be valuated at $10.7 million, which, when grossed up by its ancillary transaction costs, amounts to 26% of the $43.1 million all-in development costs. Looking at our return metrics, we find answers to questions such as how much money do I need to invest, how much money am I going to make, and when will I see my money back, as well as the internal rate of return for the different parties involved, the landowner and the limited and general partners. If the GP invested no equity capital, he would obviously not get any capital repayment nor any preferred return, only a promoted interest, which would be equivalent to about 5.4 of the equity distributions. Let's now look at the sources and uses of funds report, which basically answers the following questions. How much funding do you need to make this project happen and achieve the returns you mentioned before? How are you going to allocate those funds across your main uses? And where would you be getting that money from? Regarding the capital stack, we see the LP-GP contribution split as well as the 60% LTC loan provided by the bank. Upon development completion, we would refinance and would be able to get a feeling of the kind of ICR and DSCR covenants we could abide by. Let's take a look at the graphs, starting off with our balance sheet overview. First of all, we see in bright blue the behavior of our net asset value at all times. Then we see how by the end of the development phase, our gross asset value is equal to the cumulative $40 million book value, but from the moment we go live, since we are fully leased from day one, our GAV quickly reaches the $81 million expected market value. We also see how upon refinancing, the outstanding loan amount reaches the debt capability level. So if we did not refinance, the outstanding loan amount would decrease, allowing the net asset value to go up along with the GAV, but delaying that early distribution from year 4 to year 7, and therefore reducing our internal rate of return by 8.8%. If we didn't use any kind of leverage, we see how our NAV is much closer to our GAV. Let's now look at our LP's internal rate of return waterfall graph. One of the interesting takeaways here is the graphical visualization of how we're allocating our value creation. We can see how at the 69.2 IRR, profitability is highly boosted by leverage, and after that we can also see the impact of taxes, the landowner's distribution, and the GP's promoted interest. If we look at our development yields graph, we see how our NOI yield goes up as our building becomes income producing, and our cash-on-cash return is yielding a comfortable 4.6 to 5.3%. This model is useful mainly during the early stages of analyzing a development investment opportunity. This is usually the time when we would like, on the one hand, to determine quickly and easily whether a deal would make sense, and if it did make sense, to be able to share the idea with investors, bankers, and other potential partners using a sleek and professional document around which we could have the first round of conversations to start putting a deal together. These are the analytical and communication objectives this mini model achieves. We refer to this model as a mini model because of its great simplicity, big picture approach, and its tiny size, combined with a fine display of analytical rigor and modeling mastery, which allows it to match the results of models that are more than 100 times more robust, but also heavier and more time consuming to operate. For example, the deal that we're currently showing on the screen was originally underwritten by one of the largest real estate investors in the world, whose assets under management currently surpass $100 billion. To perform that underwriting, they used a combination of both, a very powerful and expensive real estate software and a very bulky Excel model template, which contained more than a dozen worksheets, many of which were ultimately inefficient or useless, and which was assembled by an army of real estate professionals over an extended period of time. In their model, changing one simple assumption and assessing its impact would take several minutes, a lot of Excel work, and substantial computing power, and would still not convey a clear message about the change, as models as cumbersome as those usually end up becoming a black box. After months of structuring the deal on their financial model, that army of professionals at last got to a final capital raising version whose results quite closely matched the results we're looking at right now in our mini model. The difference is that with our model, it only took us at most 5 minutes of modeling, not 5 weeks, to figure out whether the deal made sense. This model gets the job done pretty nicely and meets the highest institutional standards. This model does not have any locked cells. It is therefore 100% editable, runs on an expandable yearly timeline of up to 10 years, handles any currency symbol, and yearly or monthly rental rates. It does contain a distribution waterfall with promote after a preferred return hurdle, and does calculate post-tax returns accounting for value-add tax, corporate income tax, and capital gains tax.